Hello everyone. In my earlier videos, we have discussed about the overall profitability, profit and loss statement, what are the different profitability terms, and in my recent video, we have discussed about the gross profit, gross margin, what it is, how do we analyze it, how do we interpret it, and what are the things we need to consider in order to analyze the gross profit, right? In this video, we are going to focus on the operating profit. Yeah, what is the operating profit? How do we calculate it, how do we analyze it, how do we interpret it, what are the things we need to consider while doing the interpretation, and what are this common usage for the operating profit. Yeah, so let's begin. So if you have gone through my previous video, right, by now you must be familiar with this profit and loss statement. It's a very simplified profit and loss statement I have drawn to make you understand like what are different profitability terms and how do we calculate it. So if you are already familiar with this, then you can simply understand like how do we calculate the operating profit. So operating profit, basically it can be calculated if you have the gross profit. So gross profit minus operating expense, right? If you don't have the gross profit, if you have revenue from operation, then from revenue from operation you need to deduct the COGS, cost of goods sold, and from cost of goods sold, like after that you need to deduct the operating expense. Now how to calculate gross profit, what is revenue from operation, cost of goods sold, all these we have discussed in the previous video, so you can refer my previous video related to gross profit. Yeah, now coming back to operating profit. So from gross profit, if you deduct the operating expense, you will get your operating profit. What is, now the question comes, what is operating expense? So operating expense are the expenses which are incurred for day-to-day business operations, okay. Now in this, we don't consider the direct expense, okay, because the direct expenses are already considered in COGS. So in the cost of goods sold, we already considered the direct material, direct labor, and other direct expenses, right? So here we generally consider the indirect expenses. So in the indirect expense, for example, like SG&A, like sales, general and administrative expenses, like for example, like if the company, if there's a manufacturing company, but it also established an office, okay, where like finance people or HR people or marketing guys sit, so that office rent, okay, salaries of such people like finance, accounting, or the HR people, rent, electricity of that office, all these are non-production related expenses, basically the indirect expenses. So those indirect expenses are form part of operating expense. So SG&A, R&D, marketing expense, right, all these are considered indirect expense. In turn, those are considered as operating expense. Yeah, now another important thing is I've especially highlighted depreciation here. So depreciation is basically like when like if you have a furniture, if you have laptop or computers in your offices, right, so you utilize them for day-to-day purposes. Since you are utilizing them, so you are incurring a depreciation on them. So since it is used for day-to-day business operations, right, so that's why depreciation is also considered part of operating expense. Yeah, depreciation is also considered part of operating expense. The reason I have separately indicated it here, because depreciation is an important element for profitability analysis. As we go along in our journey, right, we will understand more about EBITDA and how for any merger and acquisition, how we calculate the profitability. In those cases, the non-cash expense, especially the depreciation, have a major role to play, right? So that's why it is indicated separately. Yeah, but otherwise it is considered part of the operating expense only. Yeah, so operating profit is gross profit minus operating expense, and these are some example of the operating expense. Now basically, now we have calculated the operating profit. Yeah, what does this operating profit show? So basically it is showing the profitability, right? But what kind of profitability? Profitability from overall business operations, from business operations. here when we were talking about the gross profit, it was more about the production efficiency, how much we are able to produce and sell at a premium, right? So it was all about the production efficiency. But here we are talking about overall business operations, or in turn you can say it, we talk about the operational efficiency. So basically it shows more on the operational efficiency side. Yeah. Okay, so now let's move ahead. Now if I give you an example, same you must have seen in my earlier videos also, but let's take it again. So if I give an example, there are 4 companies and they are having the operating profit of, let's say, 50,000, 40,000, 60,000, or let's say 90,000 or 100,000, right? So if I ask you, like, they have this the operating profit, now which company is more profitable? Okay, and if this is 40 and this is 90, yeah. So now looking at this figure, if you quickly draw a conclusion that, oh, D is most profitable, then your answer may be wrong. And as I said in my previous videos also, that while doing any analysis in finance, right, or in financial management, you cannot draw a conclusion from the absolute figure. You cannot just draw the conclusion from absolute figure. Okay, you need to talk in the relative terms. Okay, you need to calculate a percentage. Okay, so say if I give you another some figures here, like revenue. If I tell revenue is 100,000, here it's 200,000, here it's 300,000, and here it's 500,000, right? If I give you these figures now, so now your interpretation would change. Then you will think, okay, out of 100,000 I'm earning 50,000 operating profit, like 50%. Here on 200,000 I'm earning 40,000, that is 20%. Here 30%, here 20%, right? Now you'll think from that angle, then you will understand, oh, D may be earning more profit in terms of rupees or dollars, right? But in the profitability sense, A looks to be more profitable because on the revenue of 100,000, it is generating 50% profit in the operating profit, right? So this percentage is called operating margin. This is called operating margin. How do we calculate this? It's operating profit divided by revenue, and obviously multiply by 100, right? This is the operating margin we have calculated, and using the operating margin you can analyze that which company is better. Okay, it may be earning more profit in terms of amount, right, but this is not that much profitable like A, because on the earnings of 100 it is earning 50%, on the revenue of 100 it is earning 50% of operating profit. So looking at the relative term, A looks to be more efficient, it has more operational efficiency, it's more profitable in terms of, in relative terms, it has more operational efficiency. Yeah, so this is how you can analyze and interpret, right? But this interpretation, it's not something you can do just by looking at the amount or looking at the percentage. Okay, so there are many things which you need to consider before you draw a conclusion or you interpret something. Okay, so the first is you need to consider industry. When you are comparing, let's say if you are comparing company A and company D, that does not make sense if the company D is in the manufacturing whereas A is in service. Okay, you cannot just compare those two together. Okay, because since it's in the manufacturing industry, it may be having different standard. Okay, different percentage of industry specific profitability percentage. This may be having a different profitability percentage, right, or the industry standard. So you cannot compare across industry. If you are comparing two companies, you need to make sure that they belong to the same business or the same industry, right? So that is one thing you need to keep in mind, yeah, while you compare or while you interpret. Okay. Now the second thing what you need to consider is um, so let's say if you are comparing two companies, uh, company A and company B, right? So okay, let me just take an example of company A only. So let's say you are analyzing company A and you understand, okay, operating margin like year 1, year 2, year 3, year 4, right? So operating margin is, let's say it was 20%, it is 25%, then 30% or 35%. So basically it's increasing year by year. Okay, it's increasing, it's a good thing, but how do we interpret it? So what I want to say is like you cannot just interpret based on this figure. Okay, the operating margin or is dependent on operating profit. Okay, but this operating profit is also dependent on gross profit. Okay, so operating margin is increasing, we need to also understand how about the revenue or the gross margin. Okay, what's happening with the gross margin? If the gross margin is same, let's say gross margin was earlier also 40%, now it's 40% all the years, for example, it is 40% all the years, but still my operating margin is increasing. So that is something, now we can draw some conclusion that, oh, my gross profit or gross margin is remaining the same, but still my operating margin is increasing. It means I am reducing my operating expenses. Okay, because gross margin is same but this is increasing, it means I am reducing something here. So my operating expenses are reducing, so basically I'm becoming more efficient in my operation, right? So even though my gross margin is same, I'm earning more operating profit, right? But let's say if the gross margin is also increasing, let's say it was 40%, it became 50%, 60%, 65%, right? So then I cannot draw the same conclusion because my operating margin is increasing, because my gross margin is increasing, that's why my operating margin is also getting better. So my efficiency is not in operation, it may be in the production. My efficiency would be in production, so that's why my operating margin is increasing. Okay, so you cannot just compare that alone, you need to see how, what's happening with the gross margin or gross profit, then only you can draw the conclusion. Okay, so you need to check other profitability element, other profit elements. Okay, this is one thing. Okay, now the other things what you need to consider is like the trends and all. Okay, how? Again, let's take an example of one company A. Year 1, year 2, year 3, year 4, year 5, right? Say let's say the trend was 50%, so this is again operating margin 15%, 16%, 5%, 16%, 16.5%, etc., etc. Now if you are just thinking about 1 year, okay, let's say if you are analyzing a operating margin, right, of a company, okay, so you cannot just draw conclusion from 1 year also. Okay, you need to see what are the historical performance of that company, right? So in this case, let's say if you were in year 3 and if you just quickly draw the conclusion, oh, this company is not good, that's not correct, because we need to see what was the historical performance. So in this case, let's say historically they are earning 15 and 16%, and in future also they will earn, or let's say if you are analyzing overall already, like you have this figure, you analyze, okay, this year only they were bad, okay, their operating profit margin was less, but historically they are earning well, and after that year also they earned well, so it means there must have something happened here, right? So now you need to dig deeper into this here, okay, why their operating margin is less. Then you will go check again, okay, what was the gross margin, like gross profit, was gross profit also less? Let's say let's assume, let's say gross profit was same as 40%, but then why operating margin became 5 when historically it's being 15-16%? Then you can go into the operating expense and see, was there any additional expense or unexpected expense that has come? There may be a reason, there may be one time write off or something like that has happened. Due to that, those items, this operating margin have been reduced. Okay, so this is how you need to analyze. So you cannot just analyze 1 year standalone figure. If the company has a history, you need to check the historical figures also. Okay, so you analyze the industry or compare against the same industry practices, check other profit element, analyze the trend, etc. So these are the things you need to consider before you draw a proper conclusion about the operating margin. And it's not only about the operating margin, for any profitability margin, right? You need to consider these things. Okay, now let's understand what are the common usage. What are the common usage of this operating profit or operating margin? Okay, first is to analyze the profitability. As we have seen, like, we can compare against two companies. For the same company we can do the analysis and all. So to analyze the profitability we use this. Okay, the another important thing is new business. Okay, if you are starting a new business or if you are venturing into a new business, right? So obviously you will understand what's my gross margin there. Okay, but when I'm talking about the business, right? So business will include the day-to-day operations also, right? You need to establish an office, employ people, do the accounting, have the HR guys, marketing and all those things, right? So for that, when you analyze, yes, you will analyze the gross profit, but you also have to analyze the operating profit, because it shouldn't be like your gross profit is more but your operating profit is less, right? So for that purpose it is done. Now the third is for M&A. M&A means for merger and acquisition. So for merger and acquisitions also, when companies analyze the other company whether to acquire or not, they consider operating profit. For example, if there's a company A and if there's a company B, historically the company is like 15% operating margin, then year 2 16%, then 16.5%, then 15.5%. Let's say this is the trend. But for B, the trend is like, okay, 17%, 2%, then 16%, then 5%, then 10%. If this kind of trend is there, then you will understand, okay, this company is a well established company. It's a well established and it is earning consistent similar profit. But in this case, the profits are very fluctuating, sometime up, sometime down. So it may be a risky investment and it may be a like it's a steady investment or a better investment, right? So these kinds of conclusions are drawn. Again, we need to go deep dive, okay, but on the face of it, this the conclusion is drawn, right? So that's how it is used in M&A purposes. Yeah, and then another is to analyze the cost. Okay, so if I have to do the cost reduction or something, okay, so for that purpose also this is used. Example, like let's say um, yeah, means example I'll give you, but let's say like if a company is earning a good gross profit, let's say company A, company B, right? So the gross profit they are earning 40%, okay, but operating margin for this company is 10%, and it's like 25%, right? And if this is a general trend, right? Like let's say it's a general trend with this company, like it is all the way it's earning 10% only, then when company analyze they can think, oh, why am I earning less than my industry standard, okay, or why my peers are able to earn more, then they can think, oh, I need to control my operating cost, right? Then they can analyze which cost is more, which is less, which they can control, right? So that's kind of conclusions are drawn, and that's how they decide where which cost to reduce. Okay, so these are the common usage. Okay, just one more thing, since I have given you this example, so there's just one more thing I want to tell you, uh, how you can draw a conclusion. Okay, so let's say this is the same example, the gross profit margin is same, operating margin is this. Okay, but let's assume this is a new company. Okay, so on the face of it you will interpret, oh, this company is better because this is earning the more operating profit. But then we'll go deep dive. Let's understand, it's a new company. Okay, and when we analyze their operating expense, okay, then we can see the major percentages of marketing expenses like consist of 25% or 15%, for example, whereas this company is doing only 2% of marketing expense, and this is doing 15%. So since it's doing more, that's one of the reasons the operating margin is more, less. Then you can draw a conclusion, okay, the company is a new company. Okay, since it's trying to establish itself, they are doing more marketing. Since they are in the initial phase, that's maybe the reason that their marketing expenses are more, and that's the reason the operating margin is less. In future, once they are established, their marketing expense would be less and operating margin would be more. Okay, so this way you can analyze. So as I said, you need to consider the many things before you draw a conclusion, right? What's the company business model, their trend, what's the industry, and all those things, right? So but this is how you can draw some conclusions, and these are the common usage. Okay, so I hope I was able to explain you and make you understand what is the operating margin, operating profit, how do we calculate operating margin, how do we analyze and interpret, and what are the things we need to consider, industry, what are the like trend companies going through, right? Company's business model, all those things we need to understand before we draw a conclusion, and these are the common usage. Okay, so I hope this video must be useful for you. Okay, if you find this useful, please like and click on subscribe button so that you can get updates for the more video. And if you have any question or if there's any specific topic you want me to make a video for, please write into the comments. Okay, and with that I would like to say thank you and bye, see you in the next video. Thank you.